than a pure equity product.
Sure.
So there are huge kind of disconnects that we see in the market between what the AMCs believe and what the customers believe.
Sure.
So a lot of financial education, as Sandesh was referring to, and more than financial education, it is increasing the number of advisors in the market. The world has changed completely as far as the way the AMCs in the last 5 years, the AMCs have to be looked at into, and we can discuss that part further.
Sure. Sandesh, do you believe that there is a disconnect between what the investor wants and what the AMC looks at their own performance? And secondly, and more importantly, what can be done to get the investor back?
See, I think 2008, if you look at the past, 2008 is a big learning. In the sense, when one looks at the fact that perhaps you had done an asset allocation for your customer at say 50% of equity in 2005. In 2008, I'm sure that 50% would have gone to 90%. I'm telling you, in 2008, we were still selling equity. What is critical is, and the pain point I believe would have been much, much lower if one had done an asset allocation and one had moved away from product-based selling to a portfolio-based selling or a solution-based selling. Finally, the customer is looking at his entire book. He's not looking at a particular product. He's not looking at a particular asset. I think if we are able to communicate that effectively to the customer, look at what Nimesh was saying, that market is not gone anywhere, but the systematic investment plan in the same period has still generated perhaps between 8 and 10% return. Now, how does one communicate that? And that communication is something which this audience is well equipped to do. And perhaps we need to move to the next level of looking at making customer look at his entire portfolio rather than at the product level. And that is how I think wealth will get created, and that is how that is why we are there in this business.
Milind, is communication the biggest challenge that this industry faces? Because I suppose the regulatory challenges are over, the distributor model has been tweaked quite dramatically, but yet the investors doesn't seem to believe that, one, that he's going to make returns, and two, that his capital is going to be protected.
Yeah, in any sort of financial product like mutual fund, which is simple and which is maybe simple as from manufacturer side, but not necessarily from the way investors see it. And there is a disconnect in what we think is simple and what the customer thinks is simple. But having said that, you have to understand that sometimes for the investor, I was reading this somewhere, that it's like driving a car at night. So if you're driving a car at night, you can only see as long as the floodlights let you see. And if you look at the rear mirror, you only see a certain distance. So I think the psyche of retail investors, for reasons that one can empathize with, is to kind of look 1, 2, 3 years back and not more than 1 to 2 years ahead. And I think that's where the real need for communication lies. Whether you, and as Sandesh was saying, it's more portfolio allocation based advice as compared to A or B product. The other thing I feel most difficult thing to do from a distributor business point of view is to somewhere draw the line between just investing on herd. In 2006-7, people invested in equities, didn't bother about PE multiples. They thought that there was no tomorrow on this asset class. Sometimes when you look at the total business the industry now manages, which is at an all-time high, one has to sometimes sit back and see this huge flow of money into fixed income. And is that going the right way? Is it going into the right products? Is risk being understood well enough in those products? And are people buying, are being advised with a certain understanding of what's like? For example, there are products which, if you ask an investor, would you want to buy this debenture, he'll probably say no. But he's pretty happy to see that debenture in the portfolio of the fund. So I think there are some issues that we need to all the time keep in mind, is to not get carried away. See, I think you keep saying about good years and for mutual funds or bad years. I think these are just cycles. And I think for us, it's not like good or bad year. These are 2 or 3 distinct asset classes. They have their distinct cycles. And all of us would like to hope that the tough or the bad cycles are shorter and the good cycles are longer. But cycles there always will be. So having said that, what do we do in those cycles? You stay level-headed. You say don't get carried away with kind of just a feeling that this particular asset class can just fill up your asset allocation in a manner that is indiscriminately too high.
Sure.
So I think the message has to be on asset allocation, and the communication today is still very much product driven than the allocation driven. I think that over time with people like this in this hall just have to see themselves far more seriously as just advisors first and sellers second.
Sure.
Somewhere I wanted to add on that.
Sure.
Somewhere if we can make people look at, instead of last 2 years, 3 years return, more on we can make our advisors look at the future as to, and what are the factors to be looked into even by looking at an AMC.
Right.
We get a lot of customers from the Western world. Nowadays the AUM from the Western world that we manage seems to be more than the AUM that we manage in the country. And when the way they look at us is completely different. The way we are assessed over there is completely different. First thing, they try and look at the culture of the company. They try and look at the corporate governance standards of the company. Nobody has addressed asked those questions to me in India, including my distributors, that what are the corporate governance standards, what are the ethical standards. When you are managing money in the fiduciary capacity, that is the most important thing according to me.
Sure.
So those levels, what is the process that the company follows? The whole focus is not on last 3 years return. The whole focus is not on a star fund manager, that this is a big guy, he can manage whatever. It's not that. The whole focus is on discipline. The whole focus is, there is a lot of discussion on the process of fund management. Whether there are questions on how are the top management in this company remunerated.
Right.
So the way of assessing a mutual fund company itself is also very different in the Western countries than the way we have been assessed over here. Only the last 2-3 years performance.
Sure.
That's the problem.
Sure. Sandesh?
No, I think we, as an industry, it's all finally boiling down to not only chasing returns, looking at the risk that the underlying portfolio has, and moving away from perhaps selling, because in any case, let's face it, let's look at UK. UK, after having given 3 years of time, has actually moved to a complete advisory model whereby I think the fundamental question which is being raised globally, in the global financial market, is where is the loyalty? See, when I buy a shirt from Shop or Stop and it's a Louis Philippe shirt, I know that his loyalty is with Louis Philippe. Tomorrow if something wrong with the shirt, I give it back to him and I get a replacement.
Sure.
But I get to know that tomorrow. When you buy a financial product, you will get to know about the well-being of the financial, about the right decision whether you will advise over only a period of time, which is why the world over the regulators are saying that the loyalty, there is no question, the loyalty has to be with the customer. The moment you say the loyalty is with the customer, then the compensation, significant compensation flowing from the manufacturer, is it right, is the current debate globally. You have few countries who have moved to a complete charge only model.
Sure.
If you are saying that your loyalty is with the customer, you please collect compensation from the customer.
But hasn't the regulator addressed this at some level by changing the model?
They have. In the sense, the recent guideline from SEBI has addressed that. You be clear whether you are an advisor or a distributor. Indian psyche will not make it easy for getting the entire advisory platform in place in the very short time.
Sure.
That is for sure.
Sure.
But in a developed market, that has really transpired, it has started happening. So the issue now is we will move gradually in that direction. I don't believe that we are in for immediate compensation change from the manufacturer to the distributor. But if I am a customer, let's face it, and if I want an advice, I would rather pay and get a good quality advice. Because that is when I know that his loyalty will be with me.
Right.
Now, we are in that transition phase. As a nation, we are in that transition phase, and as Milind said, that we have such low levels of financial literacy that at this juncture we are nowhere closer to moving to a model whereby we will charging the customer.
Correct.
But that is where the world is moving towards, and which is where I think clearly a customer centricity at the distribution level is what will finally bring about rising financial literacy, rising trust of the customer on the underlying product that the distributor or the advisor is advising, and that is what will lead to a growth of this industry.
Milind, do you think that the existing model creates a win-win situation for everyone, for all stakeholders, for the fund house, for the distributor, advisor, and the end investor?
Now let me put it this way. Yes, there is an overarching regulatory environment in which how all of us as intermediaries should operate. But there is no regulation which says that you should not give advice. Whether you choose to be in option A or B, whether you want to be, say, execution or whatever, nothing prevents you from giving good advice to your customer at all points of time. And that's not a matter of debate or negotiation. So I don't think the key driver has to be fact. Yes, as you heard from Sandesh, unfortunately people like Sandesh are in a minority who are willing to pay for the advice that they should get. But it doesn't matter. I don't think it matters so much today that whether the client is willing to pay. I know the answer, and everybody in this room who are in the distribution business will agree with me. It is incredibly tough to get the customer to pay.
Sure.
Having said that, let's not just wish it away. Yes, it will take us many, many years to go to a full advisory fee-based model. Let us not get disheartened by how long it is going to take.
Right.
But no matter what you choose to title yourself, please give advice. That is not, that regulation doesn't come in your way.
Right.
And I think that is something that has to be simply followed.
Nimesh, you want to comment on this?
See, as I started off with, it's a completely customer-centric industry, the way it has come out in the last 4 or 5 years. So once your final product is good for the customer, the only thing, the way it will be sold will change. Instead of those NFOs, now we are talking about very clearly set products. It is a very different this one. An AMC also has to worry about the advisor, that when the advisor is committing something, the AMC exactly does that. In terms of product positioning, each product of ours has to be clearly defined what it can do, what it cannot do. It cannot be as it was earlier that you can do anything. It's a great fund and the fund manager is great. He's a great brand and in that brand he can do whatever he wants to do. Those days are gone according to me.
Sure.
It has to be very clear cut product. When our advisors go out in the market and say that this is the product, this is a value fund, then we better adhere to that this is a value fund at any point of time. When it is an asset allocation product, then we have to clearly define what the product is. So world has changed to that extent that in the last 5 years, that every product has to be very clearly defined so that the advisors are not at an embarrassing position when they come back to, when the customer, even if the market has gone down, they can always say whatever I had promised to deliver, I have delivered that. So it's a beautiful environment created for advisory to anyway come in.
All right. I'm going to shift the focus of this discussion now to industry per se. Yesterday, in fact, the chairman of SEBI hinted at perhaps increasing the net worth criteria for this industry as a whole to say, look, you know, there are only a bunch of people who are controlling a large, perhaps 70% plus of this industry. The small players, and if you're a non-serious player, as he called it, you perhaps should be looking at other industries and not being a mutual fund. Milind, comment on this. Do you see the need or would that benefit this industry if there are lesser players?
From a competition point of view, probably yes.
Yeah.
But having said that, yeah, I agree that if you are not serious and if you have very small corpuses and if you are not taking steps to meaningfully increase the reach of your product, if your fund performances have lagged behind in the league table for very long periods of time, but you still continue to get some money, I think it's kind of just not productive to have just the number of players doesn't mean anything. So I think capital, the minimum capital requirement, which is what we are talking about, is an important kind of symbol or statement of your seriousness.
Right.
But sometimes it's not always that that capital will tell you how serious you are. You could have somebody who has enough deep pockets, but still might do it as be a very serious player. But yes, it's true that if you're not a serious player, you could potentially harm the larger interests of the industry.
Sure. Sandesh?
I think, see, it's like this. Today's regulatory requirement talks about minimum capital of 10 crores, but nobody can build business in that 10 crores. So in that sense, I think purely from the basis, on the inflation adjusted basis, I think the requirement of capital, in any case, whether regulatory requirement or other, it is anyway, any case is gone up. Issue is about the seriousness of the player, and I think finally every shareholder is going to look at ROE, and if one is unable to scale up this business, one is will be not be able to garner market share. So all of us know the potential is huge, but the increasingly the entry barrier is going up.
Sure.
Right? So as long as you are able to produce, it's not only performance which is important. Performance is the base, is becoming a basic hygiene now.
Right.
In addition to that, you have to be there with the customer, stroke distributor, and unless you, for which requires cost, and hence the capital requirement per se has gone up in any case.
Sure.
I've got a slightly this one.
Sure.
I feel the number of players can be much more than what we are today also.
Much more.
Yeah. India is an infinite market. How much mutual fund we have reached, we know. I'll tell you why I'm saying this. The number of serious players required are much more than what they are today. That's what I'm saying. Because when we go into a smaller town, suppose we are the only person in that small town, then the business is X. Suppose 2 more players come into that. Actually, the business grows because all 3 of us are creating awareness. So when the industry is at a stage where we are today, where more awareness is required, what is required is more number of serious players who are seriously investing in the retail segment and not concentrating only on the wholesale market.
Sure.
So the more number of players, we are actually quite happy. The more the competition, more the awareness, sales would be better. It has been seen in the government insurance company. As the private sectors came in, the LIC business had increased.
Sure.
As more and more, because more awareness got created.
Sure.
So that I feel more number of players is still better. Only thing is, serious players are required, and capital can be one of the indicators of seriousness. Capital can only be one of the indicators.
Sure. I have about 10 minutes left. Before I throw it open to the audience, one last round of questioning. Do you see the need, if you look at the next 1 or 2 years, Milind, what do you think are the challenges before this industry? We've spoken about the opportunities, and everybody agrees that the opportunities is fairly good. What do you think are the challenges? Again, 3 or 4 days ago, we